Good morning to everybody outside of the East Coast. I'm actually in Phoenix, Arizona today, so it's still very much morning where I am. First of all, I've been on the road the past couple of days and have had the opportunity to see a number of Walker & Dunlop colleagues as well as clients, and it's quite something to get out and get back on the road. I would say that after everyone has been locked down for quite some time, it's great to get out. We had a number of meetings in Dallas yesterday in an outdoor courtyard, socially distanced, and it was a real pleasure to be able to see a number of our colleagues and be able to just talk about what's going on in the world, what they're seeing and what we are seeing as we evolve with the pandemic and our economy with the upcoming presidential election. And one of the interesting things was that many of my colleagues continued to ask me who's been my favorite guest on the Walker webcast. And as I would say to Dr. Mark Zandi, who's joining me this morning, it's really, there's no favorite. I'm just honored that people like Mark Zandi will take the time to join me on this webcast and discuss issues that are so important to all of us at these times. I'm not going to do my typical Walker and Dunlop kind of what we're seeing in the markets this morning, just because there's so much to cover with Mark, and Mark brings such fantastic perspective to all these issues that I'm going to kind of dive right in, if you will. So Mark Zandi, Chief Economist at Moody's Analytics. Mark, you were born in Atlanta, Georgia, and you grew up in Radnor, Pennsylvania, whereas you and I were talking last week. You've gotten a little bit of grief from friends and family about having sheltered in place in suburban Pennsylvania for your entire life. But you're of Iranian descent. Your father graduated from the University of Tehran and then came to the U.S. to get his master's at the University of Oklahoma and then his PhD in civil engineering from Georgia Tech. First of all, my colleague Jay Thomas, who is a huge Oklahoma football fan, pointed out that Oklahoma won the national championship in 1955 and 1956, the 2 years your father was at the University of Oklahoma. I'm assuming that turned your father into a lifelong Sooners fan. Is that an incorrect assumption?
I doubt it. I don't think he even knew what football was. He was barely spoke English when he was at Oklahoma. In fact, I'll tell you a story. He met my mom there. His engineering professor at Oklahoma turned out to be my grandfather. My grandfather introduced my mom to my dad, and they got married soon thereafter meeting in Oklahoma. But now football, I'm not even sure he knows what football is today. I have 4 siblings. 2 of them were D1 soccer players. I'm not even sure he knew that. So,
So that's interesting that your grandfather was a professor at Oklahoma. Your father was an emeritus professor at UPenn and continued to teach until he was 77 years old. 2 things. First of all, given that you went to Penn and got your undergraduate, your graduate, and your master's degree at Penn, did you ever think of following now in your grandfather and your father's footsteps of entering the world of academia? And then also talk about growing up as a first-generation American.
No. The answer is no. It never even entered my mind. Sorry about these dogs. I don't know what to set them off, but we'll power through. No, I never really thought about academia. That takes a lot of patience, and that's something I'm short on. I don't really have the patience to teach. And I never really that never even entered my mind, to tell you the truth. I never went down the academic path. I mean, I appreciate the academic lifestyle. We would get into our station. My dad would put 5 kids, including me, in a station wagon. We'd go cross country every summer and visit his sister in California. So I appreciated that kind of lifestyle, but no, that wasn't for me. I didn't have the patience to do it.
So you got your PhD at UPenn, and as I was thinking about, and I've read a lot of what you have written over the past 30 years, and we'll get into a lot of that. But I was just trying to think back, Mark, about whether there's been anything that when you were studying, sort of had great conviction about, of some, I don't know, that you thought that M1 supply was a key driver of economic performance, that tax rates were wildly important to growth in the economy, and that over the last 30 years, you've sort of changed your view on that sort of theory. Is there anything that you studied, wrote your thesis about, that you've sort of over time sort of said, you know what, now that I've got real practical experience, the practice kind of overwhelms the theory, and that you've kind of reversed your thinking on it?
Well, I used to think models, building a model, the best model, would answer all the questions. So if you had the high quality data, lots of data, and you had the right computing capabilities, and you use the right kind of econometric techniques and statistical techniques, you would be able to build a model that would be able to answer lots of questions and solve lots of problems. And my business is founded on that principle to this day. But what I've learned is the models, I'm sure for many of the folks that are listening to this makes perfect sense. It just took me a while to figure it out. Models only take you so far. That human beings are obviously incredibly complex, and it's impossible to model how people feel, particularly collectively. And that's key to determining how the economy is going to perform, how the financial system is going to do. It's people, at the end of the day, the business cycle is really a loss of faith. It's a loss of faith, but collectively, in that I'm going to have a job tomorrow, or that my business is going to be able to continue to make money next week or next month. If you lose that faith, and we lose that together, then we're in recession. Modeling that's beyond the data and techniques that we have at this point in time. So that's why it's important that there's a subjective element to the work and analysis that we do, that we overlay on top of what the models are producing, our judgment as to what's going on and where things are headed. So it's really this switch from this kind of slavish view that models would be the solution to everything, to, well, they're helpful, they're a guide, they provide insight, but at the end of the day, we live in a very complex world that is not going to be modeled, certainly not given the data and techniques that we have today.
So it sounds like you're suggesting that PhDs in economics might need to take a couple psychology courses when they're doing their.
In fact, that's what they're doing, right? I mean, since when I was in grad school, my thesis advisor was a Nobel laureate, a guy named Larry Klein, who got his Nobel Prize modeling the economy. But a generation later, 10, 20 years later, we're now kids are learning behavioral economics. So people kind of sort of figured this out, that the models will only take you so far, and you really need to get under the skin of people and try to understand how they're thinking about things, and again, not just as individuals, but collectively, how people are thinking about things.
So you started economy.com in 1990. When I saw economy.com, which you later sold to Moody's, I actually went back to see when the first URL was registered. It was actually registered in August 1991. So you were actually ahead of the .com. So I guess the first question is, what was economy.com before it became economy.com? And what part of the market were you researching and selling research on at economy.com?
Yeah, we were regional financial associates. You may remember back 1990, that was the S&L crisis, interstate banking, all the walls were coming down with regard to interstate banking. And so financial institutions were now thinking about, their footprints were expanding very rapidly, and they needed information that went beyond their very narrow regional footprint that they were in. And so that was really the basis for the company that we formed. We provided information to financial institutions who were thinking outside of their borders. And, obviously that immediately gets into real estate, housing and commercial real estate, and that's sort of how we started to cross paths early on. And then regional financial associates turned, believe it or not, we had a website called The Dismal Scientist, dismal.com, and we changed the name for about 6 months, and GE was a client at the time, and Jack Welch was the CEO. And in a meeting, he saw a chart, and the source was Dismal Scientist. And he goes, "What the hell is that? I don't want any charts from Dismal Scientist." So, of course, when Jack Welch says something like that, you listen. And so we went out and bought the economy.com URL. And by the way, that was incredibly expensive. We had to negotiate with this fella who was, do you remember this Quest? Was it Quest?
Yeah.
Denver-based, yeah, one of the baby bells. And he was squatting on all these names. And he owned economy.com. In fact, he had made a fortune. If you believe
Jim Crow was the head of Quest, I think.
Oh, is that right? Yeah, he said he was on when we were negotiating on a yacht somewhere in the South Pacific. That's how well he did. So we paid a bundle for economy.com. And I think it turned out okay, but we paid a lot of money for that particular URL. And then, then we were off and running at that point and getting into lots of different things.
So you sold economy.com to Moody's in 2005. Why'd you sell it to Moody's versus Morgan Stanley or some other research firm?
Well, interestingly enough, we had no intention of selling. We were pretty happy and doing quite well. And then one day we got a proverbial knock on the door from a good friend, a guy named Mark Almeida, who was CEO of Moody's Analytics. They had just formed Moody's, the corporation, which is known as for the rating agency, just formed this entity called Moody's Analytics. And Mark was made the president of that. And I was in a cube with him back when I was a grad student trying to make money. And we were working on, I don't even know what, but I got to know him quite well. And then he became CEO. So he knocked on the door, and we were their first acquisition for Moody's Analytics. And they've kind of grown the business from there. And I think I'm going to be wrong about this, but I think it's a $2.5 billion business now, something like that. And, very,
wow.
Very business. Yeah.
So talking about the Dismal Scientist, which you just mentioned, you were really early writing about the potential meltdown in the single-family mortgage market that led to the great financial crisis. You actually sounded the first alarm bell in November of 2005, writing, "The Fed's efforts to slow the economy will only succeed if they induce lenders to rein in their underwriting standards. Lenders' ingenuity has empowered first-time homebuyers, investors to keep buying homes despite surging housing prices and falling affordability." You go on to say subprime, Alt-A, affordable, and high loan-to-value mortgage lending have surged during the past decade. And you go on to talk about the amount of subprime and Alt-A's, and you get to a conclusion saying have ballooned from essentially nothing a decade ago to an estimated 1.2 trillion currently. So first of all, in reading your prescient analysis, it reminds me of the age-old question of a tree falling in the woods and whether it actually makes noise because nobody heard it.
Yeah.
What was the reaction to that article? You were a little early in the sense that that's 2 years before we really started to see figures in the market, but you'd seen something then that concerned you. What was the reaction in the market when you wrote in 2005 that you had concerns about the single-family mortgage securitization market?
We were dismissed. We were talking about, believe it or not, just modest house price declines nationally, and the conventional wisdom was that could not happen. You could have declines in certain parts of the country, Texas circa 1986, but this is a large diversified economy. Never would we ever see broad-based house price declines that would add up to national house price declines. And I can remember producing a forecast with a negative value for house prices. I can't remember what year it was. And people were incredulous. They thought that this was, I didn't know what I was talking about. So we got a lot of pushback. And I'll have to say I learned a lot from that. We did a lot of work around house price modeling and house price forecasting. And the models, this goes back to the models, you do have to have some conviction, courage in your convictions, courage in your models. The models were saying we were going to see some pretty large price declines. And I can remember talking to one of the analysts who's still with me today. She's a great economist, Celia Chen. And I said, Celia, we were showing a 90% price decline in Miami. And I just go, Celia, if we put that out, we're going to lose all credibility. It's just, off the charts. And so we adjusted it. We put an so-called ad factor in, and it was price decline of 30% or 35%, which was a statement in and of itself. I mean, that's cataclysmic. But would you know it, Miami house prices peak to trough fell by 90%. So, you have to have the courage of your convictions. But we got a lot of pushback. Even, in Moody's, we sold the company in late '05, right? So that's sort of towards the almost peak of the housing market. And we produced a study connecting the dots between the housing market, our views on house prices and credit. We didn't go one more step and say, what did it mean for ratings? But, anyone who read the study could figure that out. And there was a lot of internal pushback. They didn't know who is this guy? What's he saying? And why is he talking about this? What does this have to do with the economy? And fortunately, Ben Bernanke, who was the Fed chair, wrote a speech. The title of the speech was Subprime Mortgage. And that was a terrible speech. He got it all wrong. He said, don't worry about subprime mortgage. That's not going to be the issue. But as soon as he wrote that speech, that gave me license to be able to talk and write and think about subprime mortgage because, that the Fed chairman's talking about it. So my economist is certainly going to be able to talk about it. Since that day, Moody's has, given me, it's a beautiful thing about Moody's. I can think about, write about, I have carte blanche intellectually. And I ascribe a lot of that to what happened in that period in the housing bubble and housing bust.
So I want to focus on that for 2 seconds as it relates to the role that the rating agencies did play in the great financial crisis, and you being inside of Moody's and reporting about it at that time. I went back and pulled out a comment that Michael Lewis said on CNBC when discussing his book, The Big Short, and Lewis said, the rating agencies are culprit number one in all this. They put their seal of approval, they credit rated all these piles of subprime mortgage bond, AAA, and thereby allowed people who could only buy AAA rated securities to buy these things, and thereby helping to create more of these things. Without the rating agencies doing what they did, there's no way this financial crisis would have happened in the way it happened. Talk for a moment, Mark. You said that Moody's has given you great flexibility, but I guess the real question I have is, how is it that we came out of the great financial crisis and we didn't have, with all that is in Dodd-Frank, we did not have any reform to the role that the rating agencies play on rating securities and being hired by the investment banks creating those securities to give the rating?
Well, we could have just a podcast on this issue. This is a pretty meaty issue. It's pretty interesting. First thing I'd say is there's a lot of blame to go around for the financial crisis. Rating agencies are definitely on the list, but there is plenty of other players on the list. And I don't think I even put the rating agencies number one. The key, this sounds so silly now, but the key error that the rating agencies made was a stated policy, explicit policy, that they would not re-underwrite the loans that were going into the mortgage-backed securities. That was the job of the investment banks. Investment banks, they were supposed to vet the data they were getting from the mortgage lenders. They would deliver that to the rating agencies that would run it in their models and produce these ratings around the mortgage-backed securities. It was not the job of the rating agency to vet the data. They took it as given, which was crazy because it was obvious, if you were on the ground there, that a lot of the stuff there's lies. People were making stuff up, income up, appraisal values, credit scores, everything. And so garbage in, garbage out, going back to models, and, that messed everything up. By the way, that policy was simply an extension of the policy they apply to all other fixed income securities. They don't go into GE's accounting department and say, oh, are they producing producing the data appropriately that I'm evaluating the corporate debt on? That's on the corporation on GE in that example. So that's one thing that did come out of the financial crisis. There is now, post the financial crisis, the rating agencies have to vet the underlying data. They take randomized samples. They go in and they look at the credit, the underwriting files, loan files, and make sure that everything is being done properly. So that was the most fundamental error. The reason it didn't change the model, it's very intuitive. You say, okay, if investors are paying the rating agencies for the rating agencies have to be conflicted. Therefore, they're going to inflate the rating. That's very intuitive. But then you ask yourself, okay, there's some truth to that. We can mitigate that risk. We have that kind of risk all over the place, agency risk, and we have different ways of mitigating that risk. But is there a better model to replace that? And the answer is no. And let me ask you this: would you like the investors to be the ones to pay the rating agencies? I wouldn't want a hedge fund paying the rating agencies. They talk about pressure. It's one thing if you have your GE over here complaining about a rating. It's a total different thing if you got XYZ hedge fund complaining about something over here. I mean, they'll take out their knives, to get, change in ratings. So I really wouldn't want to do that. Then you may ask, well, what's the purpose of ratings anyway? Why do I need this? And there's two fundamental reasons why ratings exist and why it's so successful. One is ratings across the fixed income market is very costly. The fixed costs here are huge. And so unless you're PIMCO or, maybe a Vanguard, an army of people with $5 trillion under management, you're not going to have the resources to do this. And second, it insulates the fixed income market from legal liability to some degree, right? Because the rating agencies, the rating is an opinion, right? And, that's protected under free speech. So you can't get to the investors who, may make a mistake in their investing, but they can say, I based it on the rating, and therefore they're protected to some degree by that. By the way, I wrote a book after the financial crisis, listing who's to blame here, chapter by chapter. It's called Financial Shock. It's not the best book, but it was the first book out. And there was a chapter on the rating agencies. I wrote it. I still have it. I did not put it in the book. And I ultimately didn't do it because there was no win for me, because no one would believe what I wrote anyway, because, oh, you work for a rating agency, I'm not going to believe you. And I just make everyone else upset. So I've got this chapter, I think it's chapter 9 of the book, sitting there. And it's actually a great chapter. I spent, a month on it, and it's a really great chapter. But one of these days I'll publish it when I'm not going to make anyone mad. You
can name the book Chapter 9 and just put it.
Chapter 9. There you go. Chapter 9.
All right. So you are talking about books, Mark, and you did also write another book in 2012 called Paying the Price. And in Paying the Price, you basically underscore the role that the federal government did and the actions they took during the great financial crisis to get us out of the great financial crisis. And you go on to basically say that some of the moves they did to save Detroit and to put stimulus into the economy and TARP and other things like that, at that time, 2012, were still somewhat controversial. And your conclusion in the book is these were fundamental to getting us back up and going. And at the end of it, you say our economic future has arguably never been brighter. If you think back on the actions taken during the great financial crisis versus the actions taken by the federal government at the beginning of the COVID pandemic, talk about those two as it relates to, could the government have been quicker back in the GFC, or were they quick enough? And then I don't want to jump all the way to March of 2020 quite yet, no. So we're going to get there. But just as we're talking about what happened in the GFC, before we close the chapter on GFC and move forward to the current crisis, compare the government actions between those two crises.
Yeah, I think the significant error, well, there was two significant errors. Error might be too strong a word. You got to give policymakers a lot of credit. They were navigating through a very difficult unknown period and trying to do things on the fly. So I don't want to be too critical, but in hindsight, two things really created a problem. The first was just how slow it took to respond. In the case of the Federal Reserve, they were slow because they were inventing things out of whole cloth. All the credit facilities, the commercial paper facility, the facility for money market funds, they had to invent that from nothing, and it took them time. And by the time they got things up and running, the financial crisis had done a lot of damage to the financial system. By the way, just to power forward to the pandemic just for a second, that's a big difference between now and then. This go around, the Fed had the experience of the GFC, and they had those credit facilities. They could bring them to life very quickly, and they invented some new ones very rapidly. And they insulated the financial system from the chaos in the economy. And that's a very substantive difference between now and then. And one reason why the recovery from this pandemic is going to be tough, but it's not going to be nearly as arduous and long as after the financial crisis.
Mark, let me jump in there for 2 seconds, though. Do you think that difference in timing and the ability is due to this administration having a playbook to tap into, or a distinct view of economic theory? In other words, the activism that the Trump administration has taken to combat the pandemic and the downturn in the economy, is that due to having a playbook, or is it due to them saying, no, we know that we want to put stimulus into the market, we want to keep the markets going, and from just a general sort of economic philosophy standpoint, they were quicker to the action because of how they think about markets and the role that the government should play in them? Number
one is the playbook. They have a playbook. The experience of the GFC, 10, 11, 12 years ago, a lot of the people that are doing policy today, particularly at the Fed, they lived through that. They saw that. They experienced that, and so that was incredibly helpful. Second thing is just pure timing. Right? I mean, remember back to the GFC. That was there was the election. Obama won. Things were going to hell at that point in time. But he had to wait all the way to when he was in office, which was in January of 2009, and he passed a piece of legislation in February of 2009 that, that's a long period of time when the world is falling apart. This go around, the crisis hit in March of 2020, and we've made our mistakes here. We've made different kinds of mistakes here. The botched healthcare response, very serious error. But on the policy side, we had the luxury of, the government was there, it was operating. The other thing is, you may say, well, the Bush administration was in place, when a lot of this was going on. But I would tell you, it was when the crisis really hit back in the GFC, around, August and September and October, that administration was hollowing out. You could walk down the halls of Treasury, and there was nobody in there because they had all left. There was no horsepower. You had Paulson, the Secretary of Treasury, sitting at the top, and he had a few lieutenants, but nothing underneath. So it was very thinly staffed, and they just didn't have the horsepower, to tackle it. So it was two things. It was the playbook, and the second thing is just the timing. The timing was just been a little bit different here. But now, having said that, now we're here in the here and now. Timing is a real problem, right? Because we're in the middle of an election. We're kind of sort of where we were back in 2008, and you can see it's doing damage to the policy response because these guys can't get it together. We're not going to get another fiscal rescue package. That's a problem. That's a problem. So timing is becoming an issue now.
So we're going to dive deeper into all these issues that we're focused with right now, but let me back up for a moment to the 2013, 2014 timeframe, and then we're going to jump to 16 and then squarely into the pandemic, and then what we're going to see going forward. But in 13 and 14, Mark, you wrote two significant papers, one on the role of the government in the housing market and the mortgage markets, and the other is student debt. And on the student debt side, you predicted that student debt would be the cause of the next U.S. recession. Clearly, the COVID pandemic gets that title as the reason for the next U.S. recession. But talk for a moment about your views on student debt, and with the 1.5 trillion outstanding, and given the job market and given the education market, I'm assuming that is still as big a worry on your mind today as it was when you wrote about it back in 2014.
Yeah, I mean, obviously, this is a real critical issue. So I think we're up to 1.6 trillion. I think if I wrote about this today, I probably would say that student loan debt would not be the cause of the next recession, but it certainly would significantly exacerbate unless we do something about it. Because the thing that recognizes of the 1.6 trillion, 1.3, 1.4 trillion is now government backed, right? It's now purely government. Back then, it was mostly private. Now it's government backed. And because it's government backed, that's us, taxpayers. We backstopped it. But if you had 1.6 trillion of student loan debt in the private financial system, then that could be the cause of the next recession. That could be existential. It could take out the financial system. But nonetheless, it's still a very serious problem. It's more of a corrosive on the economy now, right? Because it's making it much more difficult for our young people to get to where they need to be to start companies. I started my company when I was 30 years old, and I could do that because I had no student loan debt, right? I mean, I didn't have any debt. And so, I was taking a lot of risk. I didn't have any income either or savings, but at least I didn't have any student loan debt. I had my wife's student loan debt. I forgot about that, but, not none of mine. But there's real clear evidence that student loan debt is really an impediment to business formation. It's one reason why business formation has been so depressed in the last 10, 15 years. Lots of reasons, but that's one of the key reasons. And it also, affects the ability and willingness of kids to start families and, do all the things that, you and I did when we were that age. And that's key to economic growth. So, yeah, I view this as a very serious issue. And I do think it's should be at the top of any the political agenda. Now that we're talking, once we start talking about the presidential election, I think this is something that needs to be addressed.
In that paper, you say that the subsidy that is inside of student loans allows for the cost of education to continue to spiral up at unbelievable rates. As a parent of 3 high school kids and soon enough 3 college kids, do you think that the current fiscal crisis that is hitting universities in the United States as it relates to the pandemic and students on campus, off campus, taking a gap year, et cetera, starts some type of reform movement as it relates to both the cost and the balance sheets of the institutions and the cost of higher education? Yeah,
I mean, I think this pandemic is going to be a inflection point for higher education. I mean, higher education, the economics of higher education just weren't working before the pandemic. Student loan debt is just, symptomatic of that. There's a lot of other issues. And the pandemic is just going to push things over the edge. So I do think we're just going to see a lot of institutions of higher education fail. And so I think we do need to rethink, very carefully what we're doing here, both with regard to student loan debt, but also, taking kind of a different perspective on things. I mean, it's kind of simple supply and demand. If I, give a person a loan to juice up demand and it's bumping up against fixed supply, you're going to see the price of that rise. That's a tuition. Kind of like the housing market in subprime, right? If I give a borrower a mortgage, a big mortgage, and they go out and buy a home, that's going to drive up the price because you're bumping up against kind of fixed supply. Same kind of dynamic. So, the logical thing would be to do in the housing market and in the student loan market is, okay, look, we need more supply. We need better, schools, online. We need better housing, affordable housing. Let's take that taxpayer subsidy we're providing to try to juice up demand, which is counterproductive because all it is driving up price, and take that and use that subsidy to increase supply. So increase the supply of affordable housing. Give funds to the housing trust fund so that they can give money to housing finance authorities so that they can go out and build, workforce housing, that kind of thing. Same with student loans. Provide more money to institutions of higher education so they can provide more services to kids that meets their needs and bring down the cost of housing, bring down the cost of student loans. So we need to really rethink, I think, how we're approaching these kinds of problems. Instead of trying to support the demand for these things, try to subsidize demand, let's think about how we can increase supply and get the cost of those things down.
So in talking about housing and student debt and the cost of education, our mutual friend Ivy Zelman was on the Walker Webcast about a month ago, and Ivy was talking about the fact that the decade from 2010 to 2020 was really a renter decade because there were these millennials who were living in cities, they were living in apartments, and that was a really big demographic driver, and that now in 2020 to 2030 you're going to get that cohort moving into wanting to start families, live in the suburbs, and own a single family home. Do you think that there's a chance that this debt load of the 1.5 trillion, as much as that would be a typical demographic sort of cycle, that actually could delay that movement to the suburbs and single family housing and keep people in multifamily housing for a longer period of time, given just the financial incapacity to be able to afford that single family home?
Yeah, I think so. I think though we need to put it into context. I don't think it's a sea change in. It's not. Here's a factoid. The median age of a first-time home buyer is about 33 years old. And by the way, that really has not risen or changed very much in the last decade or so, even with the rise in student loan debt. But if you told me because of student loan debt that, that's going to rise to 35, 36 years old, I'd say that sounds about right to me. So that's kind of what we're talking about here. It delays things by 1, 2, 3 years, which, in a macroeconomic sense is meaningful and matters. And certainly if you're in the home building industry, that matters significantly. But that's the kind of magnitudes we're talking about. It's not that it's going to take it from 33 years old to 43 years old. I don't think. And again, having said all of that, though, a lot does depend on policy, right? I mean, it depends on what we do about this problem. It's a problem. And the problem is going to get worse unless we do something about it. So hopefully we get on the other side of this election, and student loan debt and higher education costs are going to be, at the top of the kind of the policy agenda that the next president addresses.
If we take it from a 2020 to 2030 and you could only buy either a multifamily owner operator or a single family home builder, and you had to hold that stock for the next 10 years, would you buy the multifamily owner operator or would you buy the single family developer? Single
family, hands down, particularly if they're focused on that workforce housing. I mean, the vacancy rate across the housing stock is at a 35, 40-year low. And the current level of supply, even though that's up from where it was a year ago or 2 years ago, it's not enough to meet that underlying demand. So I think affordable, let's call it affordable housing around single family, I think would be where I would focus over the next 10 years. There's a real shortfall there in the need for a lot of housing.
So let's switch to 2016.
By the way, what did Ivy say? Did you ask her that question?
Oh yeah, no. Ivy's very bullish on single. She would
single?
Say the exact same thing. She'd go.
It makes me feel a lot better, by the way.
Yeah, the one piece to that I would say is just that she also actually put single family rental above single family development, but
totally
SFR right down the middle.
Totally agree.
So in 2016, you published a report looking at the economic policies of both Hillary Clinton as well as Donald Trump. And in your analysis of the Trump economic plan, you and your colleagues at Moody's wrote that the plan would result, quote, in a 2-year-long recession and a sharp increase in unemployment among other ills, unquote. You highlighted the now president's pledges to negotiate better trade deals, clamp down on illegal immigration, and enact major tax cuts to restore America's competitiveness. And your estimation at that time was we'd lose 3.5 million jobs, unemployment would be over 7%, GDP would go down, blah, blah, blah. So that didn't exactly happen, Mark. So thinking about the context of where the Trump economy was pre-pandemic and what you were looking at when you published in 2016 on the plans, either what did you miss or what did the Trump administration do that made such a distinct outcome to get the economy to where it was pre-pandemic?
Well, I think in that study, we considered 3 scenarios. And I think you're talking about the scenario where Trump sweeps, the Republicans sweep, and everything he asked for during the campaign. By the way, he was a lot more explicit about what he wanted back in 2016 than he's been in this campaign, but he was very clear about it. He got exactly what he wanted when he took office in 2016. And I firmly believe if he got what he wanted, that forecast would have come true. Remember what he wanted. He wanted a tax cut that was worth $9.5 trillion over 10 years. That was the Tax Policy Center estimate. He actually got $1.5 trillion. He wanted a tariff on China, all Chinese imports, all of them, 45%, 35% on all Mexican imports. Of course, he raised tariffs on China by 7.5%. And Mexico, he threatened it and he took them off. On immigration, he said, I'm throwing all 11.3 million undocumented immigrants out of the country. That's what I'm going to do. And so that's what we modeled. And so I assure you, if he got what he wanted, he would have had a whopping recession on his hands, pretty toot sweet. By the way, he didn't get going until the very end of 2017, right? He got into the office January 2017. He did nothing on economic policy until middle of December 2017, when he passed the first TCGA, Tax Cut and Jobs Act. So it took him about a year to get rolling. And we ran 2 other scenarios, and the third scenario was called Mr. Trump Goes to Washington. And we said, okay, he's obviously that scenario is not going to happen. What could happen? This is public information. You can Google Zandi, Trump macroeconomic policies 2016, and you'll go right to the paper. Take a look at the third scenario, and it feels pretty close to me. Not exact, but I'm saying it's pretty close to me. In bottom line, if you're asking me what do I think of his policies, I think they're pretty bad. I think they were driving us into a ditch. And if he followed through on the trade war, he stopped on that by this time last year. Remember, he called it truce. If he continued to follow on that, I think 2020 could have been a year of recession with or without the pandemic. That you had big parts of the economy already struggling: manufacturing, transportation, agriculture. They were already in recession as we were entering into 2020. The economy, this narrative that the economy was doing great is just wrong. It was already weakening coming into 2020 and very vulnerable to anything else that could go wrong.
But Mark, let me push you on that, because a year ago right now, you ran 12 economic models in conjunction with polling forecasting. And on all 12 of the models you ran, it said that Trump runs to re-election. So yeah, given that, how is it that those 12 models all came back saying Trump wins a year and 2 months from now? It was a year and a month from now. And obviously the pandemic has come in, we're going to jump to that, but what you just said doesn't foot with where the polling was and where the thoughts on the economy were a year ago. Yeah, I mean, because the economy matters, but not nearly as much as it matters in terms of elections, presidential elections, but not nearly as much as it's historically in the context of this tribalism, political tribalism that has developed. No matter what is happening in the world, the unemployment rate could go to 20%. President Trump is going to have his base and it's going to stick with him. Here's the interesting thing. In those models, we had economic variables and political variables. And on the political side, one of the key variables was the president's approval rating. And it turns out it's not the level of approval. It's the stability of that approval rating. And he has the lowest approval rating of any American president since polling began with Harry Truman, but he's had the most stable approval rating of any president until very recently, approval rating of any president. So those political factors trumped, no pun intended, washed out the ill effects of the weakened economy. And back then, a year ago, I wasn't calling for, models weren't calling for an outright recession with rising unemployment, weaker economy, but not outright recession. So at the pandemic hits, you've already said that the actions that were taken by the Fed and by Treasury were swift and were both playing off an old playbook and then also adding to it to make it so that there was sufficient liquidity in the markets. But you authored a paper with a number of both of our good friends, Jim Parrott and Bob Ryan and Laurie Goodman, called "The Mortgage Market Has Caught the Virus." And you wrote that back in April. And you note that at the beginning of 2020, private capital was coming back into the single-family mortgage market, and that with the onset of the pandemic, private capital had retreated, that in the credit risk transfer deals that Fannie and Freddie were doing, they were going out to find private capital. It had gapped way out, and so therefore Fannie and Freddie were holding on to the risk rather than passing it off. Do you think that this pandemic, given that we've just sort of gotten done with the hangover from the GFC and the mortgage markets, do you think that now that we're back at it, that the role of the government in the mortgage markets actually grows from here rather than being pulled back? Well, it depends on what we do. I think policymakers deserve credit since the GFC for reducing the government's footprint in the mortgage market. Fannie, Freddie, FHA, VA, USDA still insure mortgages that account for, let's say, 3/4 of all mortgage originations on average. But if you take a look at the credit risk that they're taking, that has been significantly reduced through the credit risk transfer process. And then what that simply means is they're taking the risk from taxpayers and selling it to private investors. So they've done an admirable job. And I would argue that, in terms of the real credit risk that the taxpayer is facing, it's probably about as low as it's been, since Fannie Mae was put on the planet in 1938. So I think they've done an admirable job. And that's why going forward, as GSE reform and potentially privatization occurs, it's absolutely critical that we continue to incent and require that the GSEs continue to offload that risk. I do think this is one reason why it makes sense for the GSEs to have significant oversight from the government, because there are times when it doesn't make sense to offload that credit risk into markets, because if you did, it would be very costly. Just think back to what was going on in the CRT market, the credit risk transfer market a few months ago. You couldn't do that economically. So at that point, you want taxpayers to hold on to that risk, play a counter-cyclical role, keep mortgage rates down. But on the other side, when things improve, then start offloading that risk. So it's very critical that policymakers, the FHFA, the regulator for Fannie and Freddie, and the Treasury, whomever becomes president, continues to support, foster, incent
this offloading of risk into the credit risk transfer market. That is absolutely critical. And by the way, that's bipartisan, right? I mean, you're saying you want the private sector to take that risk. You don't want taxpayers to take that risk. They can provide a backstop, to get catastrophic risks if things go to hell, which is what they did what they've done during the pandemic. But other than that, you want them offloading that risk, which again, they've done admirably, and hopefully, that continues to be the case going forward.
In that same paper, Mark, you and your colleagues projected 3 scenarios on forbearance in the single-family market. And you projected in scenario 1 it would get to a 10% forbearance rate, scenario 2 a 15% forbearance rate, and scenario 3 a 20% forbearance rate. And as you and I both know, the forbearance rate on single-family homes peaked at 8.55% and is now down below 7%. What is it as it relates to either the economy or the actions taken in the CARES Act or by the Trump administration that made it so that those estimates that you all looked at, which were plenty reasonable at the time, overshot the mark as it relates to the number of people who would seek forbearance?
Yeah, first thing I'd say, though, is script is still being written here. This is not over. Fortunately, we have the forbearance is still in place, which is a great thing. We're in the middle of a pandemic. This is not over. Infections are starting to rise. So, hopefully, we've seen the worst of it, but it's very good policy to have those forbearance measures in place just in case things do go in a direction that we don't want. So we need to watch that very carefully. But having said that, suppose that 8.55% is the peak. I will say the thing that has surprised me the most on the upside in this pandemic has been housing, single-family housing. It slams. I did not expect how well it has performed. I thought it would navigate through reasonably well, and certainly wouldn't be the thing that let us down. But I didn't expect this. And I think it goes to a few things. One, record low mortgage rates. The Fed acted very quickly, not only in terms of bringing down short-term rates, but they ramped up QE and bought mortgage securities and helped bring down mortgage rates. Second, the underwriting prior to all this was pretty good, and we plain vanilla long-term fixed rate prepayable mortgages that are on very solid ground. And so that good underwriting and those good products means that credit quality has remained relatively strong. All the government intervention, everything from the mortgage forbearance to the foreclosure moratorium, but more importantly, all of the government support, unemployment, stimulus checks, all the other kinds of fiscal support that has helped to support incomes of these households up to this point in time. Obviously, that's not the case now because that's all run out and we're not providing any more support. Another reason to be a little nervous about that rate going forward. But that's been very helpful. And here's the third thing that, I just did not get. Shift in preference. People, want single-family housing. I mean, this pandemic has changed people's, do I really want that Manhattan apartment? Do I really want that? I mean, am I even going back to the office? If I go back to the office, am I going to be there 5 days a week? Or, is it going to be 1 day a week or 2 days a week? So I think people's thinking about where they're going to live and how they're going to work has changed very significantly, and they want a different kind of housing. And that preference shift is showing up, pretty quickly, and I did not anticipate that. Very surprising to me.
So just last week, you were spot on in your projection as it relates to the employment numbers. So most economists were at 850 to a million jobs, 850,000 to a million jobs, and you came out and you said, nah, I think it's going to be closer to 500 to 600,000. And I know you work with ADP on their jobs report, which is at 750, but you got it perfectly. What are you looking at, Mark, from a numbers standpoint that got you right last week when many, many other people overshot the mark? And then the second thing is, what's your forward look as it relates to employment? Are we going to continue to see jobs getting picked up and people putting back to work? Are we, without a stimulus that the president came out this morning and said that he wants to back away from the table on some type of stimulus talk until after the election, are we headed towards not only not adding jobs, but actually starting to lose jobs again?
Yeah, I don't want to take too much credit for jobs numbers. That's a pretty intrepid affair. Some months I get it right, some months not. So
you got it right last month. Thank
you so much for that. But that's a difficult thing. There's so many technical factors involved, and I just got the technical factors right. I mean, I take the ADP number of 750 last month as private sector, and I knew government was going to be laying off because of teachers and temporary jobs were leaving because of the census, and that was going to drive down the number. That's how I got to the weaker number. I shouldn't take a lot of credit for that. I have a great staff that know these data very, very well and these statistics very well, and they help me with these estimates. More fundamentally, though, the job gains are slowing, and they're going to slow further, particularly if we don't get any more fiscal support. And I think by the end of the year, early next, if there isn't any additional help coming from Washington, we could see some negative numbers, and unemployment could start to rise again. That's how significant this is. I mean, just to give you a sense of it, 1/5 of American workers are either unemployed, underemployed, or have suffered a pay cut since the pandemic hit. 1/5 of American workers. That's today. It was worse 3 months ago. That's a lot of people, and they need help. And if they don't get the help, there's only one option. They stop spending and pulling back. And if that happens, then the economy is going to weaken. It's not going to collapse because you and I are just fine, and all the people listening on this podcast are doing just fine. We're working from home. The stock market is fine. So, we'll be okay. We'll keep spending. But, that 1/5 of Americans, that's still spending, and they're going to pull back, and that means we're going to see some job loss. Again, hopefully lawmakers get it together, if not before the election, soon after, and pass some additional support. But because if they don't, then they're taking a real chance here, particularly if this pandemic doesn't stick to script. If we're not past the worst of it and the pandemic does get worse, we got a problem.
So there were a bunch of pre-call questions that came in from people saying, what happens to the markets if Trump gets reelected versus what happens to the markets if Biden gets elected? What's your take on the stock market, debt rates, and what we're looking at on, I don't think it's going to be November 4th. Let's hope it's November 4th so we've got some clarity. But when we know who the next president's going to be, just what's market reaction to a Trump presidency versus a Biden presidency?
Well, a lot does depend on whether it's kind of a clean election or if it's a mess. So that's one thing. The second thing is what Congress looks like. Is it a sweep? I mean, does Biden win and the Senate goes Republican, the Senate goes Democratic and the House remains Democratic? Or is it split? My baseline view, because I have to do a forecast, an explicit forecast, and I have to make an explicit assumption because these guys are very different on every level, including their economic policy, which has very significant different implications for the economy going forward. So my baseline assumption is that Biden wins and the Congress remains split. The Senate remains Republican, House remains Democratic. In that case, I don't think we see big changes in markets. I mean, markets probably discounting that right now, that kind of scenario. If you look at betting markets, that's kind of sort of where they are. If the Democrats sweep, my guess is, you will see an initial probably negative reaction from the equity market, stock market, and the very simple reason is that Biden has been pretty clear. I mean, actually, he's been very clear. I'm raising corporate tax rates. I mean, Trump took the tax rate with the 2017 tax law down from a top marginal rate of 35 to 21. Biden says, I'm taking it back to 28. Now, I'm not going back to 35, but I'm going to 28. You just do the arithmetic, right? I mean, your after-tax earnings, take the same PE multiple, and that means prices are going to be lower. And so I would expect, 5, 7, 8% come out of the market. But, in that scenario, my view is Biden's policies will be the right kind of policies at the right time. Chair Powell said yesterday, told everyone point blank, he thinks the federal government can't overdo it here. You keep your foot flat on that fiscal accelerator. And if you look at Biden's proposed policies, which a lot of which will go through under that sweep scenario, he's got his foot flat on the accelerator. And that would be very good for getting the economy back to full employment fast. And ultimately, that's good for the economy, good for earnings. And I wrote a paper, you can take another look, Google Zandi, Macroeconomic Consequences of Biden v. Trump. You can see the scenarios, kind of what I did back in 2016. And by the end of 2024, the end of their term, stock market roughly ends up in the same place. Get there in a different way, but you end up in the same place.
Given that we're going to be in a low interest rate environment, Mark, for many years to come, if you listen to what the Fed is projecting, what's your suggestion to investors in commercial real estate as it relates to, I mean, you just said, pedal all the way down. If we're in a yield-starved world and you're getting nothing out of the debt markets, is now the time for commercial real estate investors for good assets to just be backing up the bus and trying to buy everything they could possibly see? Or do you profess more caution at this point, given what the overall economy might look like in 21?
What's your horizon? Is this the same 4 or 5 year horizon kind of?
Yeah, sure. I mean, a typical 4 or 5 year hold pattern on a,
Got it.
if you're a fund buying.
I would not be a CRE investor. I think the demand side of CRE is going to be significantly disrupted. There's going to be opportunities, right? Different markets, different property types, but broadly speaking, I think demand for commercial real estate is going to be under significant pressure. There's obvious hotels and retail, but even office. I think work from home, work from anywhere is real. It's a fundamental change. Industrial, better obviously because of online, but it depends on gateway city versus not, because global trade is going to be disrupted. And I'll end with a more controversial statement. I think that, the biggest surprise to me coming out of the financial crisis and that long recovery was how low inflation and interest rates were throughout. That was my surprise for me. I think the biggest surprise for us going forward after the pandemic over the next 5 years is how high inflation and interest rates are going to be. They're going to be a lot higher than people think, and that's going to come right out of asset prices, including CRE. So I'd be a very cautious investor in CRE.
So on that, just for a second, so your sense is inflationary pressures start to hit almost imminently, or they've got a couple of years to build, and then as it relates to rates, even though the Fed might want to keep rates low, you're projecting that the 10-year starts to float?
Well, it's post-pandemic. Pre-pandemic, it's disinflationary. Inflation will remain low. Post-pandemic, we get a vaccine or, whatever. We get to the other side of this, demand picks up. It's going to bump up against rationalized supply in lots of markets. Take the energy market. That's been significantly rationalized, the fossil fuel market. You get a pickup in demand, less supply, prices jump. Also, the Fed's basically saying, not basically, they are point blank saying, I keep couching the Fed in qualifiers, but there's no qualifier here. The Fed is saying, I'm going to run inflation hot, and I'm going to get it above 2% target for an extended period. Doing that's not going to be easy. Get it, calibrating it so it's 2.5 or 3. That's not going to be easy. It's going to be higher than people think. And then finally, on the that's all to inflation. On the interest rate side, obviously that's a function of inflation. But on real interest rates, we've got a sovereign debt issue. I mean, I think the federal government needs to press its foot on the accelerator, that we have to borrow money and get back to full employment as fast as possible. But that's not free. That's going to cost us. We're going to have a sovereign debt issue on the other side. And every country on the planet is with us. They're in worse shape than we're going to be. And that at some point, investors are going to say, hey, what's going on here? Am I going to get paid in a timely way? And we're going to have some kind of debt event. Interest rates are going to rise. And that's going to be, the combination of those two things is going to be pretty difficult for all asset prices, but particularly less so housing because of the supply shortages, but more so on the CRE side.
So final question I have, because we've run out of time, which is that you said that you ran the two models on both the Trump and Biden presidency, and you projected where the market would be at the end of their term, and they sort of end up at the same spot. Where's that market end up 4 years from now? Basically
flat, just a little higher, but goes to what I just articulated. Interest rates go up. That's going to take the steam. And the market's probably overvalued now to some degree. By the way, I'll end it this way. Pennsylvania is the key swing state. I live in Pennsylvania. I'm in the suburbs of Philly. We've done some work at a county level. The key swing county is Chester County, PA. That's where I live. And I'm only half joking. 50 Laurel Circle may be the single most important house in the United States. And it's really all about my wife and how she votes. So you watch my wife. She's going to tell us who's going to win this election. I should have had her on, Mark, and not you. You definitely should have. She would have loved it. Told us exactly where this election is going. Yeah. Look, I'm super appreciative of you spending the time. I'm sorry I had a technical glitch in the middle of our discussion. I got another 3 pages of notes to keep going on with you, but we've run out of time on this week. Thank you, Mark, very much for joining me. Great to have your insights in the markets, and everybody who joined us yet again. Thank you very much. I've got Mayor Suarez of Miami on next week to talk about running a major city in the United States in the time of COVID, and how Mayor Suarez and the state of Florida is faring right now from an economic perspective and also from a health standpoint. So I hope all of you can join us. Thank you again, Mark Zandi, and I hope everyone has a great day. Thanks so much.